Today's tech business story is not just another AI funding headline. It is a warning that the market may already be redrawing the power map between OpenAI and Anthropic. TechCrunch reports that some investors are starting to question whether OpenAI's roughly $852 billion valuation still looks justified beside Anthropic's momentum. The reason is not branding. It is growth. According to the report, Anthropic's annualized revenue climbed from about $9 billion at the end of 2025 to roughly $30 billion by the end of March. That is a huge jump in a very short period, and it changes the conversation from who is most famous to who is converting demand into revenue fastest. The most important detail is where that demand is coming from. Anthropic's coding tools appear to be doing serious work inside real organizations. That matters because enterprise software investors usually reward products that become part of daily workflows. If a model helps developers ship code faster, review changes, or automate repetitive work, it becomes easier to budget, renew, and expand. TechCrunch also says the private secondary market is telling a similar story. Appetite for Anthropic shares is reportedly intense, while OpenAI shares are trading at a discount. That does not mean OpenAI is weak. It means investors may be distinguishing between scale and efficiency, between market leadership and the price already baked into that leadership. OpenAI still has enormous advantages: distribution, brand recognition, and the ability to raise historic amounts of capital. Its finance chief argues that the company's massive recent fundraising proves confidence remains strong. That is a fair point. But giant raises can also raise the burden of proof. Once expectations reach the trillion-dollar range, strong execution is no longer enough. It has to look extraordinary. So the deeper business insight here is simple. AI investing is moving into a harder phase. The market is becoming less impressed by headline status alone and more focused on enterprise traction, repeatable revenue, and whether valuation leaves room for upside. In other words, investors are no longer asking only who leads AI. They are asking who is underpriced relative to real demand. That is why this story matters beyond these two companies. It signals how the next wave of AI winners may be judged, not just by model quality, but by product fit, monetization discipline, and whether customers keep coming back. Over the next few quarters, watch enterprise adoption, coding product stickiness, and whether OpenAI can turn scale into economics that still surprise the market.